Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, April 17th, 2024. Sorry, I was watching the Astros. They're up 4-2 against the Braves, and they may salvage this series and not get swept. So let's pray for some Astros goodness. So they're in the bottom of the sixth, and Dubon hit a home run to lead off, I think. And so now Altuve's up at bat. So anyways, if you hope you're having a good day out there, you can see my boy Jake. He is ready for some playtime. Right, Jake? You ready to go play? Yeah, he's saving his energy. So if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, a subscribe, a follow, and press the notification bell. Because again, I say smart things, not every day, usually once or twice a week. So you got to tune in every day to see when I say something intelligent. Most of the time it's just rambling. So anyways, looks like the markets were in another unhappy mood. So let's go ahead and get over there to that. Let's close that. Dow Jones was down 0.12%, 45 points, closed at 37,753. The S&P 500 down 0.62%, closed at 5020. NASDAQ down 1.15%, closed at 15,683. The VIX was also down today, 1.14%. It's at 1819. Way to go, Altuve. Just got on base. Canada up 0.06, Brazil down 0.26, and Mexico down 0.68. Heading over to Europe, Germany was up 0.12%, the UK up 0.35%, France up 0.62%, the Netherlands down 1.07%, Spain up 1.02%, Italy up 0.72%, Switzerland up 0.31%, and Portugal up 0.61%. Russian exchanges both red again today. The MOEX down 0.26%, the RTSI down 0.15%. And the Asian markets, starting with the Nikkei in Japan, it was down 1.22%, Australia down 0.9%, New Zealand up 0.68%. In China, the Shanghai was up 2.14%, the Shenzhen Component up 2.48%, China 50 up 0.79%, DJ Shanghai up 2.2%, Hang Seng up 0.02%, and the Taiwan weighted, it says it was open on the 16th, so it was down 2.68%. So kind of weird there with that chart. All right. Alrighty. So Altuve just stole second base. Woo! And I mean, unless you're watching this live, this means nothing. So, and I don't see anyone watching right now. So y'all are probably still at work. But alrighty, let's get to the market recap and see what's going on there. U.S. stocks fall on fears, interest rates to remain higher for longer. I've been saying that for quite a while. I don't, there's not a reason to lower rates unless there's either a bad market, a bad economy, something. You just can't lower rates. I mean, if inflation is still warmer than they would like, and the jobs numbers are still coming in hotter than they would like, and production still coming in higher than they would like, what reason would you lower rates? I mean, seriously, folks. But hey, I don't work for the Fed. I'm just some guy sitting in the mountains who works with a few families across the country. Alrighty, U.S. stocks experienced a reversal on Wednesday, relinquishing earlier gains due to a decline led by NVIDIA, intensifying concerns about persistently higher inflation rates from the Federal Reserve. NVIDIA's over 2% drop weighed on the broader tech sector, compounded by declines in other major tech stocks such as Netflix, Apple, Meta, and Microsoft. Chip stocks were further affected by ASML's more than 4% fall following weaker than expected first quarter new bookings. The ongoing climb in Treasury yields, fueled by fears of, prolonged higher interest rates, has soured sentiment on the growth sector, particularly in technology. The Federal Reserve Chairman Jerome Powell's recent comments underscore the central bank's intention to maintain its stance amid unexpected increases in inflation data. While the market faced pressure from the tech sector, attention also turned to the ongoing earnings season. United Airlines surged 15% after forecasting stronger than expected earnings for the first quarter and reported a narrower than expected loss in the first quarter. Conversely, travelers saw a more than 7% decline after announcing increased catastrophe losses due to severe weather conditions. J.B. Hunt Transport Services and Abbott Laboratories also experienced stock declines after missing estimates and despite beating profit expectations, respectively. Crude oil prices retreated over 2% following a rise in U.S. commercial stockpiles, raising concerns about future demand. Despite last week's surge in oil prices due to escalating tensions in the Middle East, particularly between Iran and Israel, concerns about increased inventories weighed on the market sentiment. All right, so that's what's going on in the markets. Let's move over into a little more detail here. Coming from Zero Hedge, the Beige book reveals economy is in far worse shape than the White House claims. Now, who would have ever suspected that the White House would not be completely honest with the public? Shocking, I know. All right, the latest Beige book report compiled based on, God, hang on. Compiled based on data collected before April 4th of 2024 contradicts the optimistic economic narrative presented by the White House. Despite official GDP figures indicating robust growth of 3%, 10 out of 12 Federal Reserve districts reported only slight or modest economic expansion, with 2 showing no change. Consumer spending, a key driver of economic growth, saw only marginal increases overall, with reports varying across regions and spending categories. Manufacturing activity decreased slightly, while non-financial services and residential construction saw modest increases. Employment rose at a slow pace, with many districts reporting persistent shortages of qualified applicants for certain positions despite increases in labor supply. Wage growth rates returned to historical averages, and firms faced challenges passing cost increases on to consumers, leading to smaller profit margins. Inflation remained modest on average, with disruptions in shipping causing some delays, but no widespread price increases. However, firms' ability to pass costs to consumers weakened considerably, putting pressure on profit margins. The Beige book also highlighted concerns about housing affordability and moderation of wage growth. Regionally, economic activity varied, with some districts reporting modest growth, while others remained flat. Labor markets stabilized and wage pressures eased in some areas. Overall, the economic outlook ranged from cautiously optimistic to neutral, with firms remaining uncertain about future growth prospects. The report paints a nuanced picture of the economy, challenging the prevailing narrative of robust expansion and suggesting that underlying challenges persist despite headline figures indicating otherwise. So it's, where the market is and where the economy is, and, your guess is as good as mine. I mean, I can only go by the data that's presented to me and have to make an educated decision. It doesn't look great, just looking at the big picture. If you step back 30,000 feet and you're looking at it, it's like, I just don't know. I don't feel good about this. So, all right. It all stems back to 4 years ago. We were due to go through a market downturn, and we staved it off with all the money printing. So in my opinion, we still have to go through that downturn and that market cycle that we were supposed to go through 4 years ago. And if we just continue to put it off, how much worse is it going to get? Because you have to go through the downward market cycle to then have the expansionary cycle again. And to continue just to prolong this bubble economy, I don't know. I'm worried what's going to happen. So, I think I'll be fine. I think my clients will be all right. But, for folks who aren't prepared, it's going to be a rough sledding. So, all right. Next up, also from Zero Hedge, gold's resilience shows a currency crisis is not far away. So more good news. All right. Nice throw, Bregman. Woo. Bloomberg's Mark Cranfield highlights the resilience of precious metals, particularly gold, amongst rising bond yields and a strong dollar, suggesting that investors are hedging against currency debasements. Central banks increasing their gold holdings further reinforce this perspective. With concerns about currency devaluing looming, conservative investors are increasingly turning to assets like gold, which historically hold their value during uncertain times. Despite policymakers' attempts to verbally intervene to support currencies, traders remain unconvinced. There is little enthusiasm for depleting central bank reserves, especially as the Federal Reserve, led by Jerome Powell, indicates a patient approach to rate cuts, which will likely keep the U.S. dollar stable. Interestingly, gold's performance continues to defy trends of falling ETF holdings, indicating that investors are increasingly turning to physical gold as a store of value, particularly amidst geopolitical uncertainties. Cranfield notes that the allure of precious metals is further enhanced by their portability and recognition as a universal store of value. In times of geopolitical turmoil, gold and silver serve as tangible assets with intrinsic value. Despite the weight of physical gold, its value is universally understood, offering a sense of security to investors. Overall, the current environment of economic uncertainty, coupled with geopolitical tensions, is driving investors to seek refuge in precious metals like gold, which have historically preserved wealth during turbulent times. And we are certainly there right now. It's just, 1 year to the next, it just never seems to end. So, All right. And then just some food for thought in this last article here, also from Zero Hedge, the Bitcoin halving crash course, what it is and why it matters. It's from Mark Jeftovic of bombthrower.com. So let's see what Mark had to say. All right. Mark Jeftovic discusses the significance of the Bitcoin's fourth halving, emphasizing its role in shaping the cryptocurrency's supply dynamics and price trajectory. Bitcoin's blockchain relies on proof of work mining, where specialized computers solve cryptographic puzzles to secure the network. Every 210 blocks, the block reward is halved, reducing the rate of new Bitcoin issuance. This halving occurred approximately every 4 years, enforces Bitcoin's hard cap of 21 million BTC or Bitcoins. The upcoming halving will reduce the block reward from 6.25 BTC to 3.175 BTC, potentially triggering a supply shock that has historically driven prices higher. Jeftovic highlights the logarithmic progression of Bitcoin's price, suggesting a continuation of this trend fueled by the dynamics of the halving cycle and the erosion of fiat currencies. He emphasizes Bitcoin's role as a hedge against currency debasement and wealth transfer mechanisms, predicting future scarcity as a block reward decline. Notably, Bitcoin's price has historically surged after previous halving events, with the recent all-time high exceeding 73,000 occurring prior to the current halving. Jeftovic anticipates further price appreciation driven by increased scarcity and growing demand relative to limited supply. He also notes that by 2060, the total block rewards will be less than 1 BTC per day, underscoring Bitcoin's long-term deflationary trajectory. Overall, Jeftovic's analysis suggests that Bitcoin's fourth halving marks a pivotal moment in its evolution, potentially fueling further adoption and price appreciation as investors seek a hedge against inflation and currency debasement. Yeah, if we weren't printing new money all the time, I mean, things like Bitcoin and stuff like that really wouldn't be necessary. But here we are. We have a Fed that prints money every time the economy hits a little speed bump or a bump in the road. Oh, let's just pour cash on that problem. We wouldn't want any Americans to feel any discomfort, especially in election years, 2020, 2024. So we shall see. All right. Well, that is everything that I had for today. Reminder that I will not have a show tomorrow because I will be having surgery for my gallbladder and appendix. So I will be out tomorrow, probably Friday. I mean, if I'm feeling good, I might come down and do a summary at the end of the day on Friday. Try not to do any work because, after anesthetic, you really shouldn't be, messing around with people's money. So I'm going to stay as far away from anything like that for about 24 hours afterwards. So anyway, so like I said, no show tomorrow and maybe a show on Friday, maybe not, but probably I'll definitely be back by Monday, assuming I wake up tomorrow. So fingers crossed. So anyways, all right. Well, that is everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening and I shall talk to you again next time. Adios.